Good morning. March 1st. We're already are we into spring? Actually, good question. Obviously, the markets took a big turn to the downside this week. May corn down 36 cents. May soybeans down 32. Corn, of course, led wheat sharply lower, down 48 in Chicago. May Minneapolis down 49 cents. So big down week. Of course, the USDA Ag Outlook, which I warned you about last week. They're always bearish. Actually, they weren't as bearish this year, but there were bearish numbers, especially the increased planted acreage of these three major crops, an extra 1.3 million acres. And I'll highlight some of that information here in the slideshow. April crude oil down 64 cents. April gold down a huge $105. Of course, that is showing commodities were all under pressure across the board. And maybe that's because the dollar rose a huge 1.039. That could be interesting as we go forward, though, however, kind of a blow up in the White House between Zelensky and Trump. They did not sign a rare earth minerals deal, which in my opinion was just a deal for the United States to save face. The deep state started and provoked this war. Russia didn't back down. And so obviously they were losing. Ukraine is a decimated country. And they wanted to have some reason to go into Ukraine and protect them with this rare earths mineral deal, and Zelensky just blew it up. The Democrats basically had him go in and pretend like he had some control over the situation, and he has zero approval rating basically in Ukraine. So they didn't sign the rare earth minerals deal. Ukraine is completely unprotected. They'll never join NATO, and now they're in deep doo-doo based on what Zelensky did yesterday. He's going to have to get kicked out. They're going to have elections and let them vote for who they want to, which obviously won't be Zelensky. And then maybe they could salvage something out of that country. What a disaster. There will be market implications starting the week. I'm not sure exactly what that will be. Part of the pressure also was the threat of the Trump tariffs, 25% on Mexico and Canada, that will probably go into effect on March 4th. USDA Ag Outlook, I talked about, a bearish situation, 1.3 million more acres planted of wheat, corn, and soybeans. Wheat up 700 or 900,000 acres from 46.1 in 24. Did farmers just winter? They planted more winter wheat, 700,000. They think we're going to plant more spring wheat. I think that's a foolish proposition, but that's the number they printed on paper, and that's the number we're going to trade until the March intentions report at the end of March. So they projected an 826 million bushel ending stocks number. It was 794 in 24, so a small gaining. But I think this acreage number is 400 acres, 300, 400 million acres too high. And not only that, I think they're going to harvest 500,000 to 1 million less winter wheat acres because they're going to graze it out for those high-priced cattle. 94 million corn acreage number, 90.6 in 24. A lot of people were talking about a 3 million acre increase. That's 3.4. And I think we're going to get that and more, and I'll explain in a minute. Projected ending stocks 1.965, so an increase in corn ending stocks. Everybody knew that was coming. That's actually less than I would have expected. So the demand remains strong. That's versus 1.54 in 24. Soybeans 84 million acres versus 87.1 in 24, so 3.1 million less. That's probably a 500,000 acres too high, I think. And what's interesting is soybeans gets tighter at 320 million bushel ending stocks versus 380 in 24. With a 500,000 acres less, it goes to 290. And I think they're going to have to trim the South American crop. And if there's trouble in the United States, now all of a sudden you're getting close to 200 million carryout of soybeans. You compare these to last year's USDA Ag Outlook, they basically said we'd have 850 million ending stocks of wheat for the next 10 years, 3 billion in corn, and 500 to 600 billion in soybeans. So this Ag Outlook was not nearly as bearish as last year. But based on these numbers and the expected 1.3 million acres more, I haven't talked to a single farmer that's planning on planting more wheat, corn, and soybeans because the price is so attractive. That ain't going to happen. More people are talking about, well, if it doesn't rain, this will be a crop insurance year. I'll dust the crop in and not spend much money on it because I might be in a claim situation right now. And that's Western North Dakota, the Western U.S. is dry coming into this season. So these numbers are printed on paper, not based on a survey, not based on anything else. Part of the problem with this increased acreage is cotton prices are so bad. They're expecting a shift of 1 million acres or so of cotton into wheat, corn, soybeans. So the market doesn't need to bid for acres. Really, we'll see. But for now, that's what the market is trading. And you can see the effect that that had on the marketplace. This week, corn down sharply. Basically, corn is now broke its uptrend. You have an uptrend here. Clearly, our Monday, you got 2, 3, 4, 5, 6 days. This is where we finished last week. This week, we broke that uptrend. So corn is probably going to seek out this 460 area or the next support somewhere around 450, a little below 450. That is not good. But the near term is lower prices. And you know the old saying, low prices cure low prices. That'll probably be the case. This also highlights something else in that the insurance prices were locked in here by the end of the week. We averaged 470 on the corn. That is probably close to break even for most producers. So actually, the insurance price might continue to attract those corn acres, regardless how low this corn price goes. And that is interesting, particularly when people can buy 95% ECO at 40% less than before. We're going to see a lot more of that product bought. And I'll explain why in a minute. Soybeans had a slight downtrend. I'm talking about the bullish implications of the USDA report in soybeans, right? 320 million carryout versus 380 this year. South American crop gets reduced, get a little stress on U.S. crops. I think this is becoming a pretty strong support area in soybeans. I do not expect soybeans to retreat significantly like corn and wheat have been and probably will. Part of the reason is the next 2 weeks forecast in Argentina and southern Brazil. Week 1, dry. You can see the departure from normal, way below normal rainfall. This is a development that is a little bearish, though. The rain in Argentina in the south and the far west, but actually still some area dry. We're basically the equivalent of September 1st. Will it really help the crops much? And the week 2 period remains dry in that northern Argentina, southern Brazil, where crops are going to continue to shrink. You still got heat in that same area that has dryness. And so we are going to continue to shrink that crop. Of course, week 2, they reduce that in the forecast, but it seems like the heat never goes away. Here's the wheat market retreating following corn. Looks like wheat is going to come down here and try and test that 540 low. We're already down here at the August low, but you're going to find resistance there in wheat and support. It'll be difficult, I think, for wheat to break down to new lows, particularly with the growing season coming upon us. Same pattern for spring wheat, precipitous decline here, coming down to these old lows. I don't think there's a lot of downside risk left there, to be quite frank. But obviously, the uptrend is broken for now. Probably going to wallow around at low prices, and low prices cure low prices. Looks like we're going to stay low right through planting, and the old dust the crop in and not spend a lot of money. You're going to have no choice because you're not going to make a lot of money. In fact, you're going to lose money this year. This is a defensive year. I've been talking about that the last 2 or 3 months. You got to play defense. This is a defensive year. This is probably going to be our lowest price year probably in the last 5 and then for the next 5. So this is a year you have to play defense in your risk management. Here's the U.S. forecast, which of course nobody cared about U.S. weather all winter. It made no difference to the rain outlook. But now, winter wheat coming out of dormancy, this is an important forecast right here in the heart of hardwood winter wheat country where drought normally causes a problem. You do have some above normal, some below normal rainfall, kind of inconsistent, but this beginning of heat could become a problem, particularly if we get the crop growing early and then get a late freeze. The freezes in April cause a lot more damage to winter wheat. in this hard red winter wheat country than any other kind of weather. So drought, of course, is also a concern, but for now we've got heat, but not really any lack of precip. But now we're starting to pay attention. Market will start paying attention to U.S. weather, especially on the winter wheat side. Look at crude oil. Crude oil continues its retreat like all of the commodities this week. So that's going to be good. Actually, we could come down and test these lows here in crude oil. I think support here at 66 and down here again at the year's lows at 64. But the blow up in Zelensky in Ukraine, a complete disaster for the country of Ukraine. And you know what's ironic is there are, of course, all the Democrats, Zelensky campaigned for Democrats. They encouraged him to do that. And what a disaster that's going to be for the Ukrainian country. And what is it more surprising is there are some Republicans that think Zelensky still has some chance. They're still supporting him. Completely stupid and blind policy that the United States has pursued for the last 4 years. That is not good. Ukraine wants to try and fight on without U.S. support. It's a foolish endeavor. And unfortunately, that is probably going to continue to deteriorate. Will that cause crude? There will probably be a reaction to crude on Monday, but how that settles out is going to be an interesting factor. Here, the U.S. dollar starting to pop higher. And, you know, the last time we had tariff threats, the dollar shot higher. Those tariffs actually get imposed, or will they get taken off the same day that they were threatened to be imposed? It seems like this is more a game than actual, why wouldn't Mexico and Ukraine and Canada do what they can to secure the border and avoid those tariffs, which the United States is a huge net importer. It's going to cost billions of dollars to the Canadian and Mexican economies if they don't comply. They really need to start complying, and maybe those tariffs will never go on. We'll see. So a couple other things, the gold market breaking its uptrend this week, big down week down $100 or more, broke that uptrend. So obviously there's going to probably be deflation in all the commodities going forward. Now, I wanted to talk about the implications. You've got a 470 set price. Crop insurance prices were set this with Friday, the last day. Corn actually at 470 is higher than last year's price of 466 by 4 cents. 95% of that, which you can buy 95% revenue insurance, is a minimum price of 447. There's no need to price grain anymore. Before March 15th, the 470 times 95% of that is 447. The markets are trading 455 right now. There's no use to do any hedging or trying to price corn below 470. You might as well buy your ECO 95 coverage. You've already got the ARC price support down at 433. You've got 47 cents of protection starting at 447, and you're going to get a 10% payment on ARC, and you have your revenue insurance if you buy 75% revenue or more. It's going to be a foolish proposition to do pricing of grain now. But this 470 price and this 447 worst case scenario is not under ECO is going to be extremely attractive and probably will continue to attract corn acres. We have our minimum 95% revenue. We just wait for the market to come up higher than 470 and price some of it 473, 470 or so. Looks like the USDA calculation for break-even prices in the United States for corn this year. This is going to be easy risk management, but you've got to be smart enough to buy yourself corn ECO and then expand the acres if that's more attractive than these other prices. Wheat at 657 is a minimum price of 624 on spring wheat. We're trading 623 right now. You have absolutely no risk left, no reason to market now. You have all the reason in the world to buy 95% ECO because RMA is going to pay 65% of that put option for you. It's foolish to do anything else. It looks like with this break in prices this week, ECO is going to be much, much more attractive. Soybean price Revenue price for this year is 1054. 95% of that is 1001. We're trading 1029 right now. Almost no risk left as long as you're smart enough to buy the 95% ECO. I recommend you do that, and we will wrench a profit out of here if we get an opportunity, and we almost always get an opportunity sometime between now and harvest to market that grain at a price higher. Or actually, low prices cure low prices. Maybe the best thing we can do is have low prices through planting. Don't spend as much money on this crop. We're going to solve this problem yet, but you got to be smart in your risk management. This 95% put option offered through that ECO, subsidized 65% by the government, is going to be foolish to pass up, actually. And if 470 or 470 corn and the 95% minimum is better than these other two, which I think it is for most corn farmers, we're going to continue to expand corn acres. We'll see how much we actually plant. We'll see how much winter wheat actually gets grazed out. It'll be more than last year, I'm sure, because obviously prices are clearly quite a bit lower than last year, especially for soybeans and wheat, but ironically higher for corn, even though we broke this week. So Risk Management 101 scorecard, getting the red out. I've been talking about this for a while. This is a defensive year. Buy your 75% enterprise insurance, $5 an acre on wheat and soybeans, 12 on corn, roughly at 75%. You got 25% left at risk. Buy ARC County, sign up for it for free at your FSA office. You had 10% minimum, because I think that's going to pay the full 10% this year on most crops. And that is interesting, especially soybeans. It's more likely, but so you're at 85% risk. You only have 15% at risk. Buy the ECO, obviously. You get 95% put options at a higher price than it's trading right now, paid for 65% by the government. That's a foolish proposition to pass up at this point where markets are. You only have 6% left at risk. Play in defense, cover in it, the cheapest and most economical way. Now you have 6% left at risk. You actually, if we get an opportunity to sell calls or price above the market, we're going to make some money this year, but you can only do that if you do not sell anything now below these insurance prices and lock in that profit. Of course, we have sold some new crop corn at 472. We sold 40% of the corn market. I guess we go back here in the past week or so. So I think we sold the 20% of last year's crop at 515. Basically, what is that, a week and a half ago? And we sold another 20% of 25 corn at 472 on that May contract. So obviously, that was a great place to sell those calls for harvesting ECO to pay for your ECO premium. At this point, we're below this 470 mark. We're probably not going to be able to do that. Now we know that price selection. We know what our minimum is, so now we could go on. Actually, we will have all the market upside from now until the harvest prices are determined. And I think that we're going to wrench a profit out of here yet, but it isn't going to be selling at these current levels. So you are interested in harvesting the ECO, how to make your marketing work with your crop insurance program. Actually, in this defensive year, it's going to be even more important for you to use your head. Use your head in your risk management. If you don't know how to do that, it'd be good to talk to somebody at our Progressive Ag office. I think we'll be able to sell some calls on 20% of our crop to pay for that ECO some point this year, and we might be able to lock in a profit margin even up to 5% if we do a good job selling. And we've already started selling 20% of our corn this past week. I think it was on Monday. So it is an interesting situation. We have a market that is turned down, clearly turned down, but you have risk management programs to deal with that. And I think one of the most important is to look at this ECO 65% subsidized put option that also protects your yield, county level, combine it with your crop insurance program and your marketing program. I think we can wrench a profit out of here on this defensive year, but you cannot be selling at prices well below the crop insurance price. Basically, in case of spring wheat, you're right there at your 95% ECO. You're way better off buying ECO, 95%, taking another 9% of the risk out of the market than you are doing any marketing, because that ain't going to help you. All you're going to do is lock in low prices. And that's not going to produce a profit here. So I think there's some awful big things happening on the risk management side. Prices took a downturn. Actually, it makes your risk management decisions here that you make by March 15th even more important. If you don't understand that, probably should call someone at Progressive Ag and try to help figure that out. You have a great weekend, a lot to think about, and good marketing.